All right, let's talk about something that could honestly be a total game changer for your small business here in the UK. I'm talking about the VAT cash accounting scheme. We've teamed up with the experts over at Pro Tax Accountant to put this whole guide together so you're getting top-tier insights. Ready? Let's get straight into it.
So let me ask you something. Does this sound just a little too familiar? You've put in the hours, you've done the work, you've sent off that big invoice, and then bam, a VAT bill from HMRC lands on your doormat, and they want their money before your client has even paid you. It is an absolute cash flow nightmare, right? And it puts so much pressure on small businesses and freelancers all over the UK.
So where does this headache actually come from? Well, it's all down to the difference between standard VAT and cash VAT accounting. Let's paint a picture. Meet Chloe. She's a freelance graphic designer based in London. Now, on the standard scheme, the second she fires off an invoice, HMRC's clock starts ticking. They see that VAT as due. But with the cash scheme, she only has to pay that VAT to HMRC after her client's payment actually hits her bank account. It sounds like a small change, but believe me, for her cash flow, it's a total game changer.
Okay, here's what we've got lined up for you. We're going to kick things off with that unfair cash trap, then jump into the lifeline that is cash accounting. We'll cover who can join, what it's like to use day to day, and then help you figure out if it's actually right for your business. And of course, we'll point you in the right direction for some expert advice. Let's do it. Right. Section 1. Let's really dig into this problem. What is it about standard VAT that can feel so, well, punishing for small businesses? Yeah, this quote just hits the nail on the head. Imagine you're Chloe. You've just finished a massive project. Amazing. You send out an invoice for £10,000 plus VAT. That's a £2,000 VAT bill right there. The problem, your client is on 60-day payment terms, but your VAT return is due at the end of next month. So under the standard rules, you somehow have to find £2,000 to pay HMRC out of thin air because that client's money is nowhere near your bank account yet. And that, right there, is the core of the problem. Standard VAT, or invoice accounting as it's sometimes called, ties your VAT bill to the date on your invoice, not the date you get paid. This creates that awful cash flow gap, that heart-in-your-mouth period where you owe the taxman money you literally don't have. If you deal with clients who take their time to pay, you know exactly how stressful this can be. Okay, but it's not all doom and gloom. There's a solution designed for this exact situation. Let's talk about the cash accounting scheme. Think of it as a real financial lifeline. You know, the idea behind it is actually beautiful in its simplicity. You only pay VAT to HMRC when your customer pays you. And on the flip side, you only claim back VAT on your expenses when you've actually paid your supplier. It means your VAT return finally matches the real cash situation in your bank account. Here's a really easy way to get your head around it. Standard VAT? It's like a credit card. The debt is created the second you send that invoice, and the bill is coming, ready or not. But cash accounting, well, that's like using your debit card. The money only moves when it's actually there to be moved. It's just a much safer, more grounded way to handle your VAT. Sounds pretty good, doesn't it? So the big question is, are you eligible? Let's break down the requirements. Okay, the big one is turnover. To get on the scheme, your estimated VAT taxable turnover for the next year has to be £1.35 million or less. And just to be clear, that's your total sales before you add VAT. It also doesn't include any sales that are exempt from VAT, things like insurance or postage. And what happens if your business starts flying? Well, good news. Once you're in the scheme, you can stay in it all the way up until your annual turnover hits £1.6 million. If you do go over that, then you'll need to leave the scheme, but not immediately. It happens at the end of that VAT quarter. So apart from turnover, there are just a couple of other things. HMRC needs to see that you're on top of your game. All your VAT returns and payments have to be up to date. Also, you can't have any recent VAT offenses or penalties on your record. Basically, they want to know you play by the rules. Now, here's a brilliant pro tip. This one comes straight from the team at Pro Tax Accountant. When you're working out your estimated turnover to see if you can join, keep a record of how you got to that number. Just jot down your calculations. That way, if you make an honest mistake, but you can show HMRC your thinking was sound, they won't come down on you for it. That's a great bit of peace of mind. Okay, so you've checked the boxes, you're eligible, and you're ready to go. So what does this actually change in how you run your business day to day? Let's take a look. Here's a question that sounds simple, but the answer is super important for VAT. When are you officially paid?
Because under this scheme, the date of payment has a very specific meaning, and it isn't always when you see the cash in your bank.
Let's get into the nitty-gritty. If someone pays you by bank transfer, it's easy. The payment date is the day the money lands in your account. Simple. But what about a check? The payment date is the day you receive the check, or the date on the check itself, whichever is later. And here's a really important one for card payments. The official payment date is the day you process the transaction and create the sales voucher, not the day or two later when the funds actually clear. A small detail, but a crucial one.
Okay, stick with me here, because this next part is where a lot of businesses get caught out. It is so important. Even if you're using the cash accounting scheme, there are a few types of transactions that are completely excluded. You still have to account for them the old-fashioned way, using the invoice date.
Yeah, this is the bit people miss. You really have to get these exceptions locked in your brain. So what are they? We're talking about things like hire purchase agreements or any invoice where you give a customer more than 6 months to pay. Also, if you issue an invoice for a deposit or payment in advance, that's excluded. And a big one for anyone in construction. It doesn't apply to services that fall under the domestic reverse charge rules. You gotta know this stuff.
So, we've gone through what it is, why it exists, and how it works. Now we get to the million-dollar question, or, the $1.35 million question. Is it right for you? Let's weigh up the good and the bad.
Okay, on the pro side, the absolute #1 benefit is better cash flow. No more paying VAT on money you don't have. And you get automatic bad debt relief, which is brilliant. If a customer never pays you, you never have to pay the VAT on their invoice. It's that simple. Now, the con side. The main drawback is that you can only reclaim VAT on your own purchases after you've paid your suppliers. So if your business model means you regularly get VAT refunds from HMRC, maybe you're an exporter, for example, this could actually slow down getting your money back.
This is a question we hear a lot, especially from businesses that are growing fast. What on earth happens if I get too big for the scheme? You cross that 1.6 million pound threshold. Is it a massive, painful process to switch back to standard accounting?
Thankfully, no. It's not a nightmare. HMRC has a process for it. When you leave the scheme, you do have to account for any outstanding VAT on invoices you sent but haven't been paid for. But, and this is the important part, they give you a 6-month grace period to pay it. That gives you plenty of breathing room to chase up those payments from your customers and makes the whole transition way smoother.
Wow, we've covered a lot of ground, and hopefully this has given you a really solid understanding. But of course, every single business is different, and for advice that's tailored just for you, nothing beats talking to a professional. So just before we wrap up, a quick disclaimer. Please remember that the information we've shared here is for general guidance only. Before you make any big financial decisions, you should absolutely consult with a qualified professional who can look at your specific circumstances. And you won't find better experts than the team at ProTax Accountant. They're ready to help you figure all this out. You can reach them on WhatsApp or give them a call on 07985-689-912, or just drop them an email at info@protaxaccountant.co.uk. Do yourself a favor and subscribe to their YouTube channel for more tips like this. And if you want to read up on everything we've talked about today, they have a fantastic detailed blog post on their website. Just head over to protaxaccountant.co.uk/post/cash accounting scheme. So, we'll leave you with one final question to think about. Now that you know exactly how this scheme works, what's one single change you could make in your business this quarter to get your cash flow into a healthier place? Something to chew on. Thanks for watching.